6,300 in calls.
It really changes the entire.
Trust is almost an understatement. Discount to its net asset value.
No last look models. In plain English, that means I see that as a structural.
Referring to the hedge fund rotations.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
As of March 6, 2026, the Sprott Physical Silver Trust, trading under the ticker PSLV, is sitting at a market price of $27.27. And that specific figure is really critical because it represents a negative 5.70% discount to its actual net asset value of $28.92.
Right. And if we immediately look at the off-exchange volume data, a very different picture emerges beneath that surface-level price action. Recent trading in this trust has been, well, overwhelmingly dominated by dark pools, private exchanges where institutions trade massive blocks of shares completely off the public radar. Specifically, on February 18th, that off-exchange volume hit 11.9 million out of the 20.5 million total shares traded. That specific dynamic drove a massive 69.86% short volume ratio in a single session.
Yeah. And those two data points, the physical discount and the massive off-exchange shorting, bring us directly to the central question we are exploring today. Is the current valuation and behavior of PSLV driven by a long-term structural geopolitical supply deficit, meaning the physical reality of the metal itself, or is it overwhelmingly dictated by algorithmic dark pool trading and tactical institutional financialization within the market microstructure?
Exactly the core tension.
Right. And my position is that unprecedented geopolitical catalysts, namely China's export restrictions and the U.S. Project Vault, combined with severe industrial deficits, well, they provide a definitive, unshakable physical floor for the asset.
My position is that the extreme volatility, recent technical breakdowns, and the overwhelming dominance of algorithmic liquidity providers reveal a fragile, highly financialized trading environment that frequently overshadows those physical fundamentals.
Let's start by looking at the fundamental reality of the asset, because silver has undergone a complete identity shift over the last few years. It is no longer just a secondary precious metal. It's not just a speculative inflation hedge you keep in a safe. It has become a primary critical industrial material. And the macro geopolitical shift we are seeing right now to secure it, it really changes the entire landscape.
You're talking specifically about the new Chinese regulations, I assume?
Exactly. Take China's January 1st, 2026 export licensing regime. We need to be very clear that this is not just some minor regulatory tweak to track shipments. They are now requiring an 80-ton capacity threshold for exporters, alongside $30 million in dedicated credit facilities and historical export documentation.
Which basically pulls the ladder up behind them for anyone but the absolute largest state-backed players.
Precisely. In simple terms, China's keeping the metal for their own domestic tech boom. It acts as a functional ban on small to mid-size exporters. Market participants anticipate this will reduce Western refined supply by 60 to 70%. That is a structural earthquake in the physical market. You can't just replace 70% of refined supply overnight.
Look, I don't disagree with the severity of that supply shock. It's a massive restriction.
And we must pair that with the United States response, which really tells you everything you need to know about how governments view this metal now. On February 2nd, 2026, we saw the announcement of Project Vault. This is a $12 billion strategic reserve initiative led by EXIM, the Export-Import Bank of the United States. This fundamentally alters the demand profile. It turns the U.S. government into an active, aggressive accumulator to protect domestic supply chains for aerospace, technology, and automotive manufacturing.
Right, the government stepping in as a buyer of last resort, or rather, first resort, really.
Encumbered, fully allocated London good delivery bars. They are stored securely at the Royal Canadian Mint and audited by KPMG. In a world where nation-states are actively hoarding physical resources, PSLV becomes the only logical safe haven for institutions that are fleeing counterparty risk. The physical scarcity is real, and the trust is perfectly positioned to capture it.
The physical narrative is incredibly compelling on paper, I'll grant you that. But the actual market reality of PSLV is dictated by technical fragility and off-exchange manipulation. We cannot ignore the brutal technical reality that is playing out on the screens right now. We are looking at an asset whose price dropped from a 2025 peak of $121 all the way down to $27.27.
A correction driven largely by paper market mechanics, though, not physical sell-offs.
Regardless of the driver, the chart is undeniably broken. Just a few days ago, on March 3rd, it broke decisively below its 50-day moving average. And it wasn't just a slight dip. It triggered a negative MACD indicator. For anyone not watching the charts all day, MACD essentially measures the momentum of an asset's price. And right now, that momentum is flashing a massive red warning light. It's a textbook bearish signal for near-term price action.
I see why you think that, but technical indicators are based on historical price action. They simply don't factor in a paradigm shift in global supply.
But they do factor in how capital flows through the modern financial plumbing. Furthermore, when we examine those massive off-exchange short volume ratios, like the nearly 70% we saw in mid-February, we see a market microstructure that is completely bottlenecked. Liquidity is heavily concentrated in the hands of just a few non-bank algorithmic market makers. Firms like XTX Markets and Citadel Securities are dictating the tape.
So you are saying the price is disconnected from the metal.
Completely detached. It proves that current price discovery relies heavily on high-frequency tactical hedging. The physical metal might be sitting quietly in the Royal Canadian Mint, as you pointed out, but the price of the trust is being whipped around by algorithms operating in milliseconds. The physical reality and the digital reality are divorced.
I understand the focus on short-term price action and algorithmic momentum, but let's step back and look at who is actually accumulating this asset right now. If we focus on long-term, strategic, institutional conviction, the data tells a story of massive accumulation by people who care very much about physical reality. Let's look at the Fédération des Caisses Desjardins du Québec. They are currently holding over 17 million units. That is approximately $403 million in a single, highly conservative fiduciary institution.
That's one major player, yes.
But it's not just them. Look at the aggressive first-quarter accumulation we've seen in 2026. Grand Central Investment Group just initiated a new stake, making PSLV a massive 13.5% of their total portfolio. And Kestra Advisory Services boosted their stake by over 45.3%.
I see the numbers, but allocating 13.5% of a portfolio to a single commodity trust is an incredibly concentrated, almost reckless bet.
It is, and that's exactly the point. These are not high-frequency traders looking to scalp a few pennies on a dark pool exchange. These are fiduciaries managing real wealth. They are front-running fiscal dominance and positioning themselves for a sustained geostrategic shift. They recognize that paper derivatives cannot power a solar grid. They cannot run an AI data center. When you see a conservative firm dedicating nearly 14% of its portfolio to a single physical commodity trust, you are witnessing a permanent shift in how smart money views counterparty risk. They want the metal, not the paper.
I come at it from a different way. While you highlight the accumulators, you are omitting the high-profile institutional exits that are happening at the exact same time. And these aren't small players. Major firms are actively stepping away.
You're referring to the hedge fund rotations.
I'm referring to massive coordinated drawdowns. Citadel Advisors sold off 83,800 units. Barclays liquidated almost 95% of their shares, which is a near total exit. And Jane Street Group reduced their stake by over 80.7%. These are some of the most sophisticated market participants in the world, and they are aggressively taking risk off the table when it comes to PSLV.
But again, those are trading firms. They trade volatility. They aren't structural holders.
Exactly. And look at how the remaining institutional players are actually using the instrument. Signorth Trading, for instance, has been taking simultaneous put, call, and long positions. They reported 76,800 shares in puts, 176,300 in calls, and a long position of over 87,000 shares just this February.
So they are playing every side of the movement?
Right. That is not a buy and hold reserve strategy. When you hold puts, calls, and long equity all at once, You are executing a volatility capture strategy. That shows the smart money treats PSLV as a vehicle to trade the friction, the spreads, and the market dislocations. They are not treating this as a sovereign wealth preservation vehicle. They are treating it as a highly financialized trading token to hedge against volatility in the broader technology and AI equity markets. They don't care about the silver in the vault. They care about the spread on the screen.
And market makers, they do not negate the underlying physical math. We have been in a structural physical supply deficit for 6 consecutive years. 6 years where we consume more than we pull out of the ground. And the industrial demand is not just growing, it is accelerating at a parabolic rate.
The industrial demand is undeniably robust, yes.
Robust is almost an understatement. Consider the infrastructure required for the artificial intelligence boom alone. We are looking at a requirement of 56,000 ounces of silver per nuclear reactor, just to power these new AI data centers. Just pause and think about the scale of that. 56,000 ounces for a single facility.
It's a staggering figure, certainly.
And that's just AI. Add the green energy nexus to the equation. The European Union is mandating solar integration in new commercial and residential buildings starting this year, in 2026, and the automotive shift. Gartner forecasts that electric vehicles will hit 116 million vehicles on the road this year. EVs utilize significantly more silver than internal combustion engines. We're talking about everything from battery management systems to autonomous sensor arrays.
Which all require highly conductive industrial-grade silver.
Exactly. So when Citadel or Jane Street step out of the paper market to balance their books, they aren't changing the fundamental reality that industrial manufacturers absolutely must acquire physical silver to operate. A solar panel manufacturer cannot buy a paper derivative to conduct electricity. The sheer scale of this irreversible industrial demand running headlong into a 6-year structural deficit creates an unavoidable physical bottleneck. The price eventually has to reflect the physical reality.
I completely acknowledge the industrial deficit. When you actually look at the math for the EU solar mandates and the EV build-out, it is structurally sound. I don't disagree with you there. But my issue is that physical scarcity doesn't immediately translate to price discovery when the market microstructure is broken. The physical market and the financialized market operate on completely different timelines.
But a deficit is a deficit. If there isn't enough metal, the price must rise to destroy demand. That's basic economics.
It's basic economics in a frictionless vacuum. But we don't trade in a vacuum. Right now, 60% of over-the-counter or OTC participants expect the number of active liquidity providers to shrink. That's due to massive margin compression and the soaring cost of technology-driven execution.
Meaning fewer players are facilitating the massive block trades?
Exactly. Liquidity is concentrating into fewer and fewer algorithmic hands. Look at the 20% silver futures sell-off we saw in late January 2026. The physical deficit you just outlined existed then, just as it does today. The EU still had its solar mandate. But when algorithmic market makers dictate the electronic pricing, fundamental deficits can be completely sidelined by sudden liquidity vacuums. It only cares about moving a block trade through an alternative trading system without signaling the broader market. When those systems de-risk, when they suddenly pull their liquidity, the price collapses regardless of how many thousands of ounces are needed for a nuclear control rod. The screen reality overpowers the physical reality.
I see the mechanics of what you are describing. But honestly, that is precisely why the current valuation presents such a generational entry point for the strategic investor. Yes, the algorithmic noise creates short-term volatility, but it also creates massive mispricing. PSLV is currently trading at a negative 5.70% discount to its net asset value.
Which is a substantial discount for a physical trust.
Exactly. For a fully allocated, unencumbered physical asset, to buy it for nearly 6% less than the spot price of the metal it holds, that is a prime setup. Furthermore, the trust lies near its long-term trend floor of $25.52. The downside risk is incredibly limited here.
Assuming the floor holds.
And beyond the chart, we must factor in the fiscal efficiency of PSLV's specific architecture. Because it holds Passive Foreign Investment Company, or PFIC, status, U.S. investors can secure long-term capital gains tax rates of 15 to 20%. To put that in perspective, if you buy physical coins or most other precious metals ETFs, you are hit with a punitive 28% collectibles tax rate. The tax alpha alone is a massive draw for institutional capital.
The tax efficiency is a distinct structural advantage, I'll give you that.
And finally, we have to look at the macroeconomic reality of the gold-to-silver ratio. It is currently stretched at approximately 75 to 1. Historically, during powerful monetary shifts, this ratio compresses. At the 2011 peak, it hit 30 to 1. If gold continues to consolidate above $4,000 and that ratio compresses toward its historical mean, triple-digit silver is an absolute mathematical inevitability. The current discounted price is simply a temporary gift from those very algorithms you mentioned.
That's a compelling argument, but have you considered what that extreme volatility actually means for the utility of a safe haven architecture? You mentioned the price dropping to the $25 floor as a positive setup, but let's zoom out. We are looking at an asset with a 52-week range of $9.97 on the low end, all the way up to $38.13 on the high end.
It's a volatile commodity, certainly.
But that kind of wild, erratic dispersion is fundamentally antithetical to wealth preservation. If you are a fiduciary seeking stability, seeking a true safe haven away from counterparty risk, a near 300% swing in 12 months is terrifying. It behaves more like a tech startup than a bedrock monetary asset.
But that volatility is precisely what allows for the outsized returns when the physical shortage finally bites.
Perhaps for a trader, but regarding that negative 5.70% discount to NAV, I'm just not convinced by that line of reasoning. I don't see that as a bargain or a temporary mispricing. I see that as a structural risk premium applied by the market.
A risk premium for what? The metal's physically there, audited and unencumbered.
A risk premium for the market microstructure it trades within. The market is discounting the trust because of the high-friction environment created by heavy dark pool shorting. We discussed firms like XTX Markets earlier. They execute what are called no-last-look models. In plain English, that means the algorithm can back out of a quote in the final millisecond if the market moves against them. When you have XTX executing those models and Citadel Securities absorbing massive block trades, the retail or institutional investor holding the physical trust is the one left carrying the bag on that structural volatility. The discount exists because the instrument itself is caught in a brutal tug-of-war between physical illiquidity and digital overfinancialization.
So to summarize my position based on everything we've covered today, I return to the foundational physical reality of the asset. Algorithmic microstructure, dark pools, and high-frequency trading certainly create short-term noise and staggering volatility, as we've discussed. But algorithms cannot print physical bullion.
No, they cannot.
They cannot synthesize the conductive silver required for an EV battery management system or a nuclear control rod for an AI data center. The convergence of the U.S. Project Vault securing a $12 billion reserve, the stringent Chinese export licensing cutting off Western supply, and irreversible industrial demand has permanently altered silver's valuation framework. We have transitioned into an era of strategic resource nationalism, and in that specific environment, PSLV's architecture holding fully allocated KPMG audited ounces outside the traditional banking system makes it a premier strategic asset. The short-term technical breakdowns are simply the friction of a market attempting to price in a massive, unavoidable paradigm shift.
And in my summary, I maintain that ignoring the market's financialization is incredibly dangerous for anyone allocating capital in 2026. The physical deficits are entirely real, but the price discovery mechanism for this trust is entirely digital and highly concentrated.
The tape still rules the day.
It absolutely does. As long as algorithmic dominance persists, as long as we see dark pool short volume ratios spiking to nearly 70% in a single session, and as long as the technical tape breaks down beneath crucial moving averages, PSLV will remain a highly volatile tactical instrument. It is vulnerable to sudden liquidity vacuums and the tactical rotations of massive firms like Jane Street and Citadel. The physical scarcity of silver in the ground does not protect the unit holder from the financial reality of the screen.
Assuming the fundamentals will smoothly override the market microstructure is a fundamental misreading of how modern liquidity actually operates.
This discussion clearly illustrates how analyzing both the physical supply chains and the digital market microstructure is absolutely necessary to truly grasp the complexity of modern commodities. We are looking at a market caught between two immense forces: geostrategic scarcity on one hand and highly concentrated financialization on the other.
There is certainly much more to explore within the source material on this topic, particularly regarding the specifics of the EU's solar mandates and the deep ongoing technological shifts happening among those off-exchange liquidity providers.
The tension between the physical bar in the vault and the digital trade on the screen will continue to define this asset for the foreseeable future. We leave it to the listener to weigh the evidence presented today and draw their own conclusions on where the true value lies.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!